What if the very retirement fund you've spent decades building ends up becoming the thing that costs you the most? You picture a hefty 401k or IRA balance as a safety net, a cushion that lets you sleep easy, knowing you'll never run out of money. But hidden in the tax code are traps designed to claw back massive chunks of your savings, especially once that balance crosses certain invisible thresholds. Imagine turning 72 and discovering that missing a single calculation on your required minimum distribution could trigger a 50% penalty on thousands of dollars you're supposed to withdraw. Or learning that the higher your withdrawals push your income, the more the IRS and Medicare team up to hike your Part B premiums by hundreds of dollars every month. Even if you play by the rules, a healthy nest egg can drag you into the 3.8% net investment income tax, snatching away a slice of your dividends, interest, and capital gains. And don't forget how those big withdrawals can suddenly make up to 85% of your Social Security taxable, erasing the tax benefits you thought you had locked in. It gets worse. One large distribution could catapult you into a higher tax bracket, wiping out credits and 0% capital gains you banked on. And if you accidentally overcontribute or stumble into a prohibited transaction, the IRS can hit you with excise taxes that range from 10% all the way up to 100% of the amount involved, no questions asked. In this video, we're pulling back the curtain on 6 IRS rules that turn a too-big retirement fund from asset to liability overnight. You'll hear real stories of retirees blindsided by penalties they never saw coming and learn exactly which thresholds to watch, how to stagger your distributions, and which strategies can keep your nest egg genuinely yours. Stick around, because the biggest danger in retirement may not be running out of money, it might be having too much in the wrong places. Required minimum distributions were supposed to be a simple mechanical step, a year-end checkbox to ensure you're paying taxes on your tax-deferred savings. But for anyone sitting on a large IRA or 401k, a single miscalculation can trigger the IRS's deadliest penalty: 50% of the amount you should have withdrawn but didn't. Here's how the trap works. Once you hit age 72, you must calculate your RMD based on IRS life expectancy tables and your account balance as of December 31st the year before. You then have until December 31st of the current year to take that exact amount. Miss the deadline or withdraw even $1 less, and the IRS demands half of the shortfall. If your RMD is $40,000 and you accidentally pull only $38,000, they impose a $1,000 penalty on you, on top of the tax you still owe on the full $40,000. Real stories aren't hard to find. A retiree in California thought an automated distribution plan covered RMDs, only to learn that his custodian misread his birth date and set the withdrawal for January 2nd, one day late. The result? A $15,000 penalty and months of paperwork to request a waiver. Another taxpayer delayed her RMD calculation because she expected a market rally that never came. By the time she logged in, her balance had dipped, and she inadvertently underwithdrew by several $1,000s, triggering penalties that ate into her emergency fund. What makes this rule so brutal is the combination of complexity and cost. Large account balances require larger distributions, increasing both the absolute size of any mistake and the stakes of the RMD calculation. Compounding the issue, the IRS presumes negligence unless you can prove reasonable error and that you took steps to rectify the shortfall promptly, usually by filing Form 5329 and attaching a letter of explanation. Even then, waivers are granted at the IRS's discretion, not automatically leaving retirees in limbo. The only reliable defense is vigilance. Set multiple reminders, calculate your RMD as early in the year as possible, and work with a trusted advisor to double-check the math. Because when it comes to RMDs, the difference between compliance and a costly oversight can be, and often is, a matter of thousands of dollars. When your retirement fund balloons, those hefty withdrawals can push your modified adjusted gross income well past Medicare's comfort zone. And that triggers IRMA, the income-related monthly adjustment amount that can tack hundreds or even thousands of dollars onto your Part B and Part D premiums each year. Here's the catch. Medicare looks at your hold harmless AGI from 2 years prior, and if that number crosses specific thresholds, you're assigned to a higher IRMA bracket. So, a one-time spike from selling a large block of stocks or taking a giant IRA distribution can haunt you for at least a couple of years. Imagine deciding to withdraw $100,000 in one calendar year to cover travel or home renovations, only to learn that your 2023 Seattle home sale, combined with RMDs, vaults your AGI into IRMA's top tier. Suddenly, your standard Part B premium of around $174 per month balloons to over $500, and your prescription drug plan surcharge adds another $100 or more each month. That's nearly $5,000 extra out of pocket year after year until your income dips back below the first threshold. And remember, once you land in a bracket, you stay there for the entire year of the review and the year after. Far too many retirees look only at the income they need today, neglecting how that number echoes through Medicare's pricing formulas. Worse, there's no undo button unless you qualify for a life-changing event appeal, and those are rarely approved simply because your portfolio had a good year. To avoid becoming an IRMA victim, it pays to stagger large distributions over multiple years, use Roth conversions carefully, or explore qualified charitable distributions that reduce your AGI without shrinking your nest egg. Because in the battle between a big retirement fund and Medicare's surcharge schedule, the IRS and Medicare have the upper hand unless you plan your income strategy with every future premium increase in mind. The more your nest egg earns in dividends, interest, or capital gains, the more likely you are to face the 3.8% net investment income tax. And when your portfolio grows large enough, that surtax can quietly drain tens of thousands off your returns. This tax kicks in when your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 as a couple, meaning that every dollar of investment income beyond those thresholds is effectively taxed at your ordinary rate, plus an extra 3.8%. Imagine a $500,000 portfolio generating a conservative 4% yield. That's $20,000 in income. If your wage income or RMDs push your magi above the threshold, you'll owe an extra $760 in surtax for that year. And because portfolios typically grow and retirees often maintain consistent withdrawal rates, that surcharge becomes an annual expense. Worse yet, capital gains from selling positions or converting traditional IRAs to Roths also count toward that net investment income. So, a single strategic move can trigger a sizable surtax on top of your regular liability. Retirees we've spoken with described the shock of receiving a tax bill months after they thought they'd covered all liabilities, only to discover that their brokerage statements hid the calculated NIT liability until it was time to file. And unlike ordinary income tax, you can't offset this surtax with losses below the threshold. It applies to net investment income after gains and losses are netted, meaning you can't easily wash it away. The result is a stealth tax that grows as your portfolio grows, punishing those who've had the most success in saving and investing wisely. To blunt its impact, retirees are drawing down taxable accounts in low-income years, harvesting losses to offset gains, and strategically timing Roth conversions so that they don't tip their magi over the surtax thresholds. Because once you know how the NIT works, you realize it's not just about how much you earn, it's about keeping your investment income below the radar that triggers this hidden penalty. When you combine hefty IRA or 401k withdrawals with Social Security, you risk pushing up to 85% of your benefits into taxable territory, a double whammy that can shred your after-tax income faster than you think. Here's the catch. Social Security taxation hinges on your combined income, which is half of your Social Security, plus your adjusted gross income and non-taxable interest. Once that figure crosses $32,000 for singles or $44,000 for couples, up to 50% of your benefits become taxable. Push past $44,000/$58,000, and the tax bite swells to 85%. Now, imagine you take out $40,000 from your IRA in a single year. That withdrawal alone can catapult your combined income from a safe zone, where your Social Security was tax-free, straight into the highest bracket. Suddenly, instead of enjoying your full benefit, you're surrendering most of it to Uncle Sam. Worse still, because those extra withdrawals already bumped your magi into IRMA surcharges for Medicare, you'll face higher Part B and D premiums on top of the taxes you owe. It's a brutal cascade. A big fund feels like freedom, but every dollar you take can trigger a chain reaction that eats away at both your retiree benefits and your pocket. Retirees tell stories of expecting a modest tax bill on their retirement income, only to find their Social Security, as much as 85% of it, taxed at rates they never planned for, forcing them to revise budgets for groceries, utilities, and healthcare. The only way to avoid this trap is to model your combined income, well, before you take large distributions, staggering withdrawals across years where your Social Security will already be lower, or offsetting some income with tax-free sources like Roth conversions. Because in retirement, it's not just about how much you withdraw. It's about understanding how each dollar ripples through every corner of your tax and benefits landscape, and keeping those ripples from turning into waves that wash away your hard-earned security. Pulling large chunks from your retirement accounts might deliver a hefty payday today, but it can also catapult you into higher tax brackets, eroding not only that distribution, but wiping out deductions, credits, and those prized 0% capital gains rates you counted on. Imagine planning to sell $75,000 worth of mutual funds to cover expenses, only to learn that extra income pushes your taxable earnings past the threshold where the 15% capital gains rate applies, so you're suddenly looking at 20% or even 23.8% on long-term gains. At the same time, that same distribution can phase you out of the child and dependent care credit, the saver's credit if you still qualify, or the student loan interest deduction, credits that would have saved you hundreds or thousands more. Even the standard deduction offers no shelter once your bracket jumps. At a certain point, every additional dollar you pull out is taxed at the top marginal rate. Retirees share tales of running seemingly benign simulations, only to underestimate how steeply their marginal rate climbs, leaving them staring at a tax bill that dwarfs the cash they plan to use for a dream vacation. And it's not just about current income, it's about every future year you remain in that higher bracket until you can bring your adjusted gross income back down. The result is what analysts call bracket creep, where inflation-adjusted bracket thresholds fail to keep pace with rising incomes, pushing people into higher rates over time without any real increase in purchasing power. The antidote is strategic staggering. Spread distributions over multiple years, use tax loss harvesting to offset gains, or leverage Roth conversions during lower growth cycles to minimize bracket spikes. Because in the world of retirement withdrawals, timing isn't just everything, it's the difference between keeping your deductions and watching them vanish in a single tax season. Overfunding your retirement accounts or accidentally stepping into a prohibited transaction can feel like an academic misstep, until the IRS slaps you with excise taxes that can range from 10% of the excess to a staggering 100% of the entire account balance. Here's how it happens. Say you contribute too much to your 401k or IRA. Maybe you received a rollover that, combined with your regular deferrals, exceeds the annual limit. That excess contribution isn't forgiven. It triggers a 6% penalty each year. It remains uncorrected, compounding annually until you withdraw it. Some retirees assume they can amend the mistake at tax time, only to find out that the IRS views any late correction as a new distribution, subjecting them to income tax liability, and if they're under 59 and a half, a 10% early withdrawal penalty on the entire amount. Even worse are prohibited transactions. Things like using your IRA to buy property you personally use, lending funds to family members, or allowing your plan to hold collectibles. Those errors instantly disqualify the entire account, causing the IRS to treat it as if you received a full distribution on January 1st of that year. Suddenly, what felt like a minor oversight can become all taxable in one shot, plus the 10% penalty, effectively decimating your hard-earned savings. We've spoken with retirees who thought the rules only applied to sophisticated moves, only to learn that mere administrative flubs, like forgetting to transfer a rollover trustee to trustee and taking the money personally for a day, count as prohibited transactions. The IRS's stance is clear. Ignorance isn't a defense. The only way to avoid this trap is vigilance. Track every contribution, confirm rollover mechanics with your custodian, and keep prohibited transaction lists on your radar. When in doubt, consult a qualified professional before touching your retirement account assets. Because in the world of IRS penalties, a small slip in the fine print can blow up your entire nest egg overnight. Your retirement fund's size shouldn't feel like a sword hanging over your head. But in today's tax landscape, a large nest egg can become exactly that. We've peeled back 6 hidden IRS and Medicare traps that punish big account balances, the brutal 50% RMD penalty for underwithdrawing, the IRMA surcharges that hike your Part B and Part D premiums when your Magi crosses arbitrary thresholds, the 3.8% net investment income tax that quietly chips away at your dividends, interest, and gains, the way generous withdrawals can suddenly make up to 85% of your Social Security benefits taxable, the bracket creep and lost credits that arise when a one-time distribution vaults you into higher tax rates, and the excise taxes from excess contributions or prohibited transactions that can wipe out 10% or even 100% of your retirement plan. Each rule on its own can sting, but together they turn a healthy balance into a minefield that punishes success. The good news is that none of these penalties are unavoidable if you plan your withdrawals strategically. Automate your RMDs early in the year and double-check them against IRS tables. Stagger large distributions over multiple tax years. Use Roth conversions to smooth your Magi, and explore qualified charitable distributions to lower your taxable income without shrinking your savings. Keep an eye on your IRMA bracket by understanding how Medicare reviews your old year AGI, and time withdrawals around years when your Social Security or investment income will be lower. Track every contribution to avoid excess fund excise taxes, and ensure rollovers are trustee to trustee to sidestep prohibited transaction traps. Finally, lean on professional advisors or tax software that models your income and tax profile years in advance, so you're never surprised by a penalty that could have been spotted months or even years before it hit. Your retirement fund is meant to buy freedom, not arbitration with the IRS. By understanding these 6 hidden rules and weaving them into your income strategy, you can protect your hard-earned savings, minimize surprise bills, and ensure that your nest egg remains a cushion for your golden years, rather than a booby trap.